Hello and welcome to our summer refresher event and this panel debate. Today we're going to be discussing the rise of technology and its rapid deployment, necessary deployment as a result of the COVID-19 crisis, and what that might mean for the future of our industry. My name's Stuart Wilson, I'm the B2B Marketing Director at Key Group, and to help me discuss this important topic, I've got a range of subject matter experts to join this panel debate with me today. In the studio today, I've got Stuart Wilson, or the other Stuart Wilson of the Equity Release World, CEO of Air Group, and also Rob Brennan, Director of the Equity Release Experts and former Director of TRER. Welcome to you both. It's great to have you in the studio in person today. And rather appropriately, although they couldn't join us in the studio, we have a range of other guests who are joining via a Zoom link. We have Rob Bowes, Product Manager of sourcing platform Iress, Mark Goodfellow, Product Manager at Valuation Experts e.surv, and also Stuart Powell, who's the Managing Director of Ocean Mortgages. Welcome to you all today. Now, we will be opening up the debate later on today for questions and answers. So if you do have any burning questions you want to put to any member of the panel, you'll be able to do that at the end of the debate, but you can pose your questions right now. You just need to use the Q&A panel on your dashboard. If you can't see it or you've closed it down by mistake, just press the purple Q&A icon at the bottom of your screen. You might need to scroll right or left across your screen depending on the resolution of the device that you're watching this on to see the Q&A panel. So before we get into the meat of this debate and we talk about the way in which technology is impacting this market and the future of this market, I wanted to pose a question to all of you to kick us off, if I may. Some people might say that the equity release market has been a bit of a laggard in terms of the adoption of technology, paperless, signatureless technology, API interconnectivity, that kind of thing. Stuart, if I can turn to you in terms of that question and the growth of Air Mortgage Club and the way in which technology has been used to interact with your members. What's your view on the take-up of technology in the equity release market?
Thank you, Stuart. Let's put some imagery to this. I think we're coming out of the Stone Age, and prior to COVID, we have discovered that wheels that are square aren't going to work. We've moved to the evolution of the round wheel. And I think now, post-COVID, we've got to figure out how to put the engine, the air conditioning, and all the gadgetry into it. And I think that puts us into today's perspective of where we as a sector face the technology challenge. Are we behind the curve? Yes, we are. Have we got the ambition to catch up and potentially, being a small growing sector, maybe overtake other sectors in financial services? But there is work to do, and I think what COVID has done is, if you like, bring that agenda forward, move the focus into the reality that technology is not optional. We as a sector, if we're going to become more efficient, deliver better outcomes for customers, we have to embrace technology. But there is a warning, I guess, that we can build into this discussion today, and that's that technology for technology's sake sometimes may not work. How many times are we all sitting at home cursing the failure of our internet connection, going to events, spending ages trying to synchronize projectors and computers and rebooting our operating systems. So technology can actually create work sometimes. So it has to be fit for purpose, and it has to move the agenda on and make our sector more effective. So yes, we're behind the curve, but I think the ambition and the ability is there, but we mustn't now put the ball down. We've got to take the opportunity to progress this.
Great. And Rob, if I can bring you in, same question really, but from your perspective at the head of one of the big specialist firms in this market, what's your take on the integration and the use of technology in the equity release world?
The equity release market in comparison to the mortgage market, the pension market, and the other financial services market is massively behind. Even some of the big, well-established companies have been slow to the party in developing technology for our particular marketplace in respect of things like mortgages, protection, fully integrated systems that just work in parallel with each other. It's only been recently, the last 2 or 3 years, where we've had quote and apply for some lenders, and even in the current market, some lenders haven't got a quote and apply feature, which is for all the other types of business, they have the technology and everything in place. Yet for our sector, they don't. So the actual lenders need to develop that technology, which will then, from an advisor's perspective, make the whole experience a lot easier to deal with. It'll make it more efficient. It will help from a customer's perspective. My only fear in relation to technology is the demographic of the people that we're dealing with, in that I do feel there's a place for technology in making it easier for the advisors to write and do the business. But sometimes clients like a more touchy-feely people buy from people. And I do think there's still certain clients out there that have a fear of technology and wouldn't want to see too much technology in the actual sales process itself.
Thanks, Rob. And I'd like to bring in the guests we have on Zoom now, if I may. Stuart, if I can ask you, what's your take on the overall adoption of tech in the equity release market prior to COVID?
Yeah, I think pre-COVID, technology and equity release, I would say we thought we were better than we were. We thought we were further ahead than we were. There were certainly some leading lights. I think the things that More to Life were doing, the sourcing systems, were where we need to be now. COVID has accelerated everything. We have coped far better with people's lending needs during lockdown than the residential mortgage industry. But why would we go back? Why would we not continue to evolve? So yeah, I think we've learned a lot during COVID times that we just need to continue and improve on, but get everyone in industry working to the same level, rather than just one or two companies pushing ahead whilst the others wait.
Thanks, Stuart. And I want to put the same question really to you, Rob. What's your take on the overall adoption of tech in the equity release market?
I think the adoption of technology has been quite good. There's been kind of an existing process for quite a few years in terms of sourcing and certainly the areas that Iress are involved in with equity release. So brokers are well adjusted to that. I think the key challenge we've seen really is the changes in the market, the innovation, the number of products and the number of other things, meaning really that, for example, the number of products has increased at least 8-fold in the last few years, a real need for change. So I think brokers were using the technology well, but the technology was also disconnected, and that's the way we found a lot of these things have started with, the sourcing journey being separate to the CRM and that being separate to the lender platform. So there's a lot of rekeying, and things don't start by being joined up. That's kind of the end destination that we need to get to. But certainly, with the growth in the market, the attitude of the lenders, the desire for brokers to adopt and use, I think all the factors were there to actually get things moving, even prior to the pandemic starting. And obviously we know the pandemic has changed things a lot and probably accelerated that in a number of areas.
And Mark, if I can turn to you from a valuation perspective, or valuer's perspective, do you believe equity release industry has embraced technology or not?
I believe that the equity release market has embraced technology. One thing that comes to mind from an evaluation perspective is the utilisation of the Quest system, as well as information that's supplied to us via the Survey Hub platform. So although the equity release market has adopted new practices, I still believe that they are some long way behind sort of the mainstream lenders with regards to embracing new appraisal methodologies. However, there are signs that the sector is willing and ready to move forward with embracing new technologies, which is really encouraging.
And Stuart, I'd like to put a point to you, if I may. Some research that Key Group did recently with around about 600 intermediaries and advisors across the later life lending market found that roughly 2/3, 62%, said that they'd started to deploy phone-based and video-based technology to deliver advice to clients in a way they'd never done before. What's your experience in terms of the kinds of technology solutions that you've employed in your business in response to COVID?
The technology that we've used, it's been an extension of pre-COVID times, but they have become more crucial. By that I mean, obviously the recording of calls, the Zoom, that's the obvious one, so I won't go into that too much, but perhaps the things behind that, the social media use, the going to where your clients are rather than where your clients have traditionally come from. I know a huge part of equity release brokers' lead generation is from industries, whether they be solicitors, accountants, will writers, who just haven't really been working. They've been off. So part of the reason the equity release industry hasn't been as successful in Q2 and some Q3 is the referrers haven't been there to refer the leads. So we started end of last year, beginning of this, to really focus on social media and getting to where our clients can find us rather than waiting for other people to find us clients. And that's been a real key to our success during lockdown.
And if I could ask, it's really interesting, what was the reaction like from your clients? It's an older demographic, of course, so what was the reaction from them in terms of the deployment of this new technology?
I think people's use of technology, especially our older clients in their 70s, I think we've really done them a bit of a disservice, because the amount of 70-year-olds and beyond who are actually really young in outlook is huge. My parents, are an example, are in their 70s. They're on Facebook more than me. They're on their iPads more than me. So for you to actually speak to those clients on something that they're using day in, day out anyway, it's not an issue. We've made it an issue, not them. We've said we want you to come and see us, not them. We've said we're coming to your home, not them. So, we've perhaps put our stereotypes onto them. But once you have conversations with them, it opens new doors. As an example, we want our clients to have spoken to their family about equity release. We now can have a Zoom call with the family on the call, asking great questions. And boy, do the family ask more challenging questions than those taking out equity release. And we know why that is. A, because they're really concerned for their family, but B, they have a vested interest. If the parents are going for a high rate of interest and not paying anything back, eventually there's going to be very little left for them, the family. So some of the questions they ask are really good protecting of both their parents and of their future inheritance.
That's a really interesting point there that Stuart's made there, Rob, from your perspective. In terms of this older demographic, what's your view in terms of the way that the equity release experts has deployed technology as we moved into and through this crisis?
I think one of the things Stuart said was lockdown. Lockdown just completely stopped our market. Most of the business that we wrote was on a face-to-face basis, where we went out to see clients, sat down with them in their homes, etc. Obviously, lockdown stopped that, and very, very quickly we had to deploy technology into our advisors to enable them to carry on writing business. Now, from that, we started with telephone-based advice, which the advisors a lot of them had never ever used, never done any telephone-based advice. So it was a big challenge getting a compliant sales process put together for the advisors to undertake with clients. We then moved on to Zoom conference calling. As Stuart said, that is much better because you're able to interact with people. One of the things that has happened during COVID is, with people in lockdown, a lot of older people have had to rely on telephone calls with their family. Most of them then have got used to Zoom technology. So they've actually got used to using that outside of the equity release market. So actually using it as part of the sales process sort of has helped clients. But again, it's not right for all clients. There are certain clients that we've had that have waited 3, 4, 5, 6 months to now have face-to-face advice because they don't want to use technology. So I certainly think there's a place for it in the marketplace, but not an overall, that's the only way you can do business. I think it needs to be client-driven. I think it needs to be a choice. And as long as we offer all the choices, then we can cater for every eventuality.
And Stuart, what's your take on that debate around the use of technology there? The older demographic and how they're taking to the use of more video-based and phone-based technology. Is that something you're finding your members are deploying more and more now?
Yeah, absolutely. I think we're seeing an age group that's getting younger. There's more interest from the younger consumers. But let's not forget, and this has been referenced by Rob and Stuart, we've got consumers who are very savvy. The fastest growing age demographic in internet shopping is the over 60s. We know that. We know they're engaging because, firstly, they've been forced during COVID. And surprise, surprise, when situations force people to adopt technology, it's awkward and clunky and a bit cumbersome at the beginning. But now they're buying virtually everything online. So that fear factor has very much moved away from the consumer group. Let's not also forget that not only is our consumer demographic older, but so therefore is many of our advisor demographic age groups, that people often operate with their consumers within a sort of an age band not too far, no more than 5 or 10 years from themselves. So we've got a sort of double challenge here. The technology usage and integration has to be fit for purpose for our customer experience, but also for our advisor experience. So they're really broadly the same age group, and both of them will have the same challenges. And going back to Rob's point, it's important that we get the usability that doesn't take away that personal experience, because this is a very personal sector, and that personal service is critical that we don't throw that out.
Thank you. I want to turn to the subject of sourcing platforms now. Both Iress and Airsourcing, significant platforms in this market, used by hundreds of advisors to produce thousands of comparison sessions every day in this market. Rob, from your perspective, did you witness any changes in advisor behaviour in terms of search sessions or the usage of Iress throughout the early days and weeks of the pandemic?
Yeah, so we have seen quite a lot of change in broker behaviour as a result of the pandemic. I think prior to the pandemic, most brokers were so busy they were working with their existing processes, and this isn't just a feature of equity release. This is very common, and just don't really have time to revisit. I think the pandemic enabled people to take a bit of a step back and take stock, and also forced them to do things which they knew were right. So they are using more of the technology, probably using the richer elements of the technology that they never tried before, going to that next level of detail, and doing new things, like they might have done webinars with their clients for the first time. So I think they've done that, and once that starts moving, the benefits are very clear, and so it has led to a greater embracing of the technology, and also actually coinciding with the pandemic, a number of the technology changes we've made have gone in, and brokers have embraced those. The feedback has been great. We can see the usage, and people wanting to find out more.
And just thinking about the points you made there, Rob, are you seeing any greater take up of this type of technology with smaller firms in this market now?
Yeah, absolutely. I think more brokers from different areas types of advisors are coming to the sector. We've known for a while a lot more brokers have the qualification to sell equity release than ever sell it. So I suspect that a number are kind of finding it more interesting, finding that it is a quite an important part of planning, and should certainly be considered more often, especially with rates being so low. With rates on a lifetime mortgage being under 3%, with the flexible features, the ability to pay back now, it's there's a lot of cases where equity release may well be suitable where they weren't before. So yeah, a lot of advisors moving in, and so since the pandemic, we've had over 70 new firms sourcing on our service for the first time, which is probably about where it would be prior to the pandemic, so certainly no less. And looking at those firms, there's a whole range. There's pure mortgage brokers moving into equity release. There's small independent financial advisors. There's even some wealth management firms as well, maybe 4 or 5 relatively large wealth management firms that we've seen quoting on our sourcing for the first time. So I think it's becoming core, and any advisor that's kind of doing the retirement planning, they need to have a way to either do it, or if not, they certainly need a good process to refer to someone that will do the equity release case for them.
And Stuart, just thinking about what Rob said there, from your perspective in terms of air sourcing, have you seen any changes in advisor behaviour? Has there been an upsurge or a decline in the usage of air sourcing throughout the pandemic?
Yeah, there has been, echoing some of the points that Rob's very eloquently put across. I think we've seen huge numbers of new firms. We've seen, I'll give you an example of a change, very, very obvious change that interestingly we thought would fall away, that's maintained, but I think there's a reason behind that. We saw a number of KFIs being generated per customer rise drastically to almost just under 3 KFIs being generated per customer. Now that was unheard of before, because the advisor got to the point of having filtered down using the technology to the right product. Then to move into the full KFI was generally, for those experienced advisors, 1 KFI, because they knew the best solution for the customer. That went up. Now we put that down to, as we moved into the early phases of COVID, the fact that some providers would park applications and didn't have an ability to move them to valuation at that time. Some would turn those cases away, and some would very early on, like More to Life, would be able to process cases very much end to end and still utilising the technology and desktop valuations, deliver an offer and ultimately the ability to complete. So what actually was happening was advisors were, if you like, almost dual tracking, and they were, the cheapest rate may be a lender that wouldn't be able to process a valuation at that time. The other lender that was slightly more expensive could process, so therefore they were going back to the customer and literally giving them an option, and that was almost unheard of. We then expected, as we saw physical valuations returning, that to drop away, and it didn't. The reason for it was then the profile, as Rob's alluded to, of the huge number. We've had 430 new advisor firms join during that lockdown period. So the searches were at an all-time record. Our figures for April, for May, for June and through to July were just going up and up and up. So activity certainly changed. But the other interesting change was the depth and the richness of what advisors were actually coming to the system for. So it wasn't, the length of time was quadrupling that they were spending on the system, but they were not just comparing the simple dynamic binary of the sort of product sourcing tool, but they were then using a lot of, we've got a whole raft of calculators, for example, and the one that we saw a massive upsurge, 400, 500% increase on, was a borrowing calculator where they could show the customer the effect of paying back some or all of the interest. And that echoes Rob's point that we're seeing more engagement from families. So whereas it might have begun with a roll-up lifetime mortgage conversation, the family then having that involvement are then saying, well, hang on, if we pay some of the interest, that's going to protect our interest and your interests, mum, dad, and therefore we'll help you service that loan, we'll support you to do that. So there's a much deeper, richer advice system and engagement with advisors and the sourcing platforms, which is, it's an evolution for us that we are evolving just the sourcing to add that richness, that CRM functionality, so advisors can get much more out of it. And I think that plays into a lot of the points we've already raised.
Thank you, Stuart. And I'd like to turn to the subject of valuations now, and if I can bring Mark in at this point. And Mark, the valuation process had to adapt really quickly, didn't it, at the onset of COVID with the rollout of remote valuations. There seemed to be a bit of a negative perception towards this. Do you agree with that? And if so, do you think that those attitudes are changing now?
Yeah, so I can understand the sector's nervousness and concerns around the use of the remote valuation product. I know historically many lenders and the funders would require a physical appraisal to be done on the property. That's purely, I think, that the equity release market tends to be a lot more risk averse, and there would be concerns that certain defects may have been found. But the technology that we deployed during COVID, which I believe will continue to move forward over the short to medium term, is a more robust and viable solution for providing a accurate evaluation. And with the valuation process itself, we carry out a lot of pre-flight checks. We do various background checks, looking at previous inspections, looking at property portals, as well as satellite imagery and Google Street View. And we combine this with the valuer's knowledge to provide the valuation. And one thing that the advisors may not be aware of is that we also complete what's called an SCT report, which is a comparable report, which is completed to the same standard as would be for a physical evaluation. And added to that, we have a real-time audit process where certain cases are checked by our audit team before they are returned back to the valuer. So I think the perception of the remote valuation product is changing, and that's purely down to what we have been able to demonstrate working in partnership to demonstrate that the product is as viable and robust as a physical appraisal.
And Rob, just picking up on Mark's comments there, what's your take on this? Have advisor perceptions of the remote valuation changed at all?
I think definitely from our marketplace, if remote valuations hadn't been able to take place, then the market was on its knees. The fact that we could quickly move to a remote valuation process just kept the market going. I know there were some issues around being able to get accurate or complete information for some valuations to be taking place, but the majority of them actually come back and allowed the market to continue. So it was a massive step forward. Going forward, do I see it as normality? In some scenarios, I think going back to physical valuations, I think from a funder point of view is where I think the funders would prefer to be.
Great stuff. And Rob, and just as we're talking about this integration of new technology, we've just been talking about remote valuations there. I know Iress has been upgrading its own system recently. What's the driver behind this, and have we still got further to go, do you think?
Yep. So I think the drivers are really the amount of innovation and product change in the marketplace, the new features, the amount of information that brokers need to understand the products, and the challenges around having that stored in so many places. So a strong move to storing centrally and getting messages back real time from lenders, and also fulfilling a long outstanding broker need to be able to get KFIs in the sourcing things that they put all the information in, and coupled with just the desire on the lender side to innovate with the technology as well, and the market just being really ready for that. So yeah, great to see that out there delivered. That is just the starting point. The next logical stage is the full application process, starting from the sourcing. So you just click an apply button, you're taken to exactly the right place on the lender's system to proceed with the case, and then we can also integrate on the other side with the broker CRM system, so that where the fact find is done, all that data flows into sourcing and flows into the lender system as well at the end, and that's all established in product lines like protection, which have been big enough to deliver that a long time ago.
Thanks. And Stuart, I mean, air sourcing has been going through an upgrade as well recently with the integration, for example, of the knowledge bank criteria platform. What's been the driver behind that and the reaction from advisors to the integration of that kind of technology?
We carried out a substantial amount of research with our user base, and we've got 6,000 advisors using the platform. And I think the feedback was generally that they wanted more than just the one dimension of sourcing. So we deployed, just as an example to put that into perspective, 26 update or upgrades during COVID on air to reflect the feedback that we were getting from members. We also deployed a whole raft of base level integrations with white label sites across the industry, with a large number of distributor partners networks and IFA organisations. So that programme will continue with great gusto, and the evolution of where we now need to take it is driven by the need of brokers to have, it's out of town shopping mentality. It's getting as many things together, as many tools in one place, and single point data entry. So with the use of API that we ingrained with Knowledge Bank, client data entered once, and then you decide which direction you wish to cascade it. All simple, seamless, integrated, and big cost savings for advisors and time saving.
I want to return to one of the points we raised earlier around the evolution of technology in this market, and the way in which the equity release market is perhaps catching up with other industries that might be a little bit further ahead than ours in terms of the adoption of technology. And Mark, if I can turn to you, I know e.surv uses a huge amount of technology, doesn't it? Do you see this as something that advisors will need to consider themselves and need to look at going forwards?
Yes, e.surv does use a lot of data and technology to inform the valuation process. For example, e.surv produces a monthly market briefing which provides insights into the property market, and also our parent company LSL has a dedicated market intelligence page which includes information around house prices, housing price index and mortgage monitor reports. So I definitely recommend that your advisors review those resources to help them get an understanding of how the property market is changing, and also that would definitely help inform their conversations with clients.
That's great. And Stuart Powell, if I can bring you in now on the role of new technology in this industry, in social media in particular. I know you're a great advocate and exponent of that. What's your view on that, the use of that type of technology in our industry?
Yeah, I think social media in our industry is very much in its infancy, but that's really exciting. Over the last couple of years, our industry has changed massively. But so is the social media industry. It is more of a commerce platform. People are going there to find out the answers to their questions. And we've got a whole raft, we've got hundreds of thousands of people in this country who have got an old, outdated, stereotyped idea about equity release. And gradually, through our education on social media, we're changing that. And the more of us that do that, a rising tide lifts all ships. So if we've got tens, hundreds, thousands of us advisors, lenders, funders, brokers, mortgage clubs going on social media and correcting incorrect facts, spreading the story about how great the rates are, the products are, the benefits are, then we will get our message across to more people. I think the other aspect in which social media seems to be growing, and this is somewhere we really need to highlight and improve, is the interaction between brokers themselves, the interaction between brokers and lenders, the interaction between brokers, lenders, and those hidden people, the funders. I think the Equity Release Group, the Equity Release Hub, I started only 3 months ago, and already we've got 250 members on it, and so many of the members on it are one-man bands, two-man bands, three-man bands who haven't really had people to communicate with, to throw their ideas up against, to gain new thoughts, sourcing, marketing ideas, and that's the future, us looking after each other, us helping each other. The lenders are on forums like that now, and to have that instant rapport with lenders, with BDMs, with heads of, it's really great, and I see that's the way it goes in the future. You know, the groups on Facebook and LinkedIn.
Thank you, Stuart. And Rob, if I can turn to you from your view inside, from a specialist advisor perspective, what's your view in terms of the way technology has enhanced or adapted the entire customer journey now?
I think technology over the years has definitely improved the customer journey, but I do think it's got a long way to go. There are so many individual parts to the journey, from lead generation right through to legal completion. There's so many people that work in between that, from valuers to search engines, to solicitors, as well as the advisors, and then the lenders themselves. All of those need to come together to enable that to be one seamless journey. I think from a customer's point of view, at times it can seem a bit of a long journey from start to completion. But I think if we can get every one of them to invest in technology, we can drastically speed that whole process up.
Thank you. I want to finish up by posing one final question to all of my panel members, if I may. Reaching back to that research that I mentioned a little while ago, we found that roughly one in four, about 23% of advisors felt that the key lessons that would be learned by this industry as a result of the COVID crisis was a greater reliance on technology, less reliance on paper, and a broader range of communication options for clients and more streamlined processes. So if I can come to you, Mark, first to consider that question, and particularly in relation to remote valuations, as we move forward through and beyond the end of this crisis, do you think the remote valuations and the technology that e.surv is deploying, are they here to stay for the long term?
I believe that remote valuations are here to stay for the equity release market. As I said earlier, it's all around working collaboratively to set the appropriate risk levels. And I think from the learnings that we've had when we deployed the product within the mainstream lenders, is that we undertook a lot of testing, a lot of trials, to make sure that the lender was comfortable with the outputs when compared to a physical appraisal. So I think over the next few months, we would like to embark on that journey with the equity release market to give the funders that confidence and reassurance that the remote valuation approach is as robust as a physical appraisal. We're also looking at alternative technologies and data sources whereby we could draw upon those from an evaluation perspective to get better insight into the risk profile of that particular property. So I do believe we're on a cusp of changing, and I think using the technology is a natural way forward. And for me, the main recommendation I give from learnings is that we work with yourselves to make sure that the controls that we put in place are satisfactory. Test those controls, but then fully embrace the change, because I believe it's here to stay.
Thank you, Mark. And Rob Bowes, if I can turn to you, do you think technology is going to play an ever greater part in our industry going forward?
Yeah, I think that's a great question. I think, as you said, all the challenges and issues with doing things remotely and via technology are being solved. I think the ease of the setting up webinars now and how good that technology now works is a huge driver. So there's webinars have been around for a long time, but now you can just kind of switch on, see people's face, and I think that's so much more personal than a phone call. With equity release, quite often you need to get family members involved, and if family members are all in different places, they can all see each other, look in each other's eyes, and make sure that they're on the same page in a way that wasn't possible not so long ago. So absolutely, and so all the barriers are being taken down, and that process works. I think so. The role of face-to-face is really just when that personal touch is needed. I think depending on the individual, it certainly will be. Some would want to sit down with people, obviously, when our circumstances allow, much more of that type of interaction. And so it's, the advisor would never need to kind of see the client just to get something signed or to get something done. But when it's kind of having that personal interaction, then that's really valuable. I think it's something that's going to suit a number of the clients best for a long period of time. But yeah, there's certainly see a lot less of it. That part of the process can be done with the visit, and then all the procedures, and once the decision's been made, everything else can be done. No need for signatures or anything like that. So I think that's how I see it playing out in the future.
And Stuart, the same question to you. What's your view on this?
Yeah, I very much see technology playing a huge part in the future of equity release advice. We've gone that way during COVID, but absolutely it's the future. I can see a time where virtually all of our appointments are recorded via Zoom, via phone calls, and we will absolutely be giving most of our advice remotely. And there's the safety issues for that, and there's the convenience issues. You can't replace the personal touch. You can't replace the trust and relationship aspects that you have to build up with a client. But how are you going to do those differently? If you've got recommendations from another business, chances are they've built up that relationship with the client already. And if they introduce clients to you, then that trust is very often transferred. But a huge number of clients aren't coming to us now, and more so in the future from referrals. They'll be coming from to us from where they've done their research. And where are they doing their research? They're Googling, they're going on Facebook, some of them are going on LinkedIn, they're going on the social media platforms. And if you're not there, they can't see you. If you're not there educating them and answering the questions they've got, they're not coming to you. They'll come to your competitors, they'll come to those companies who've got it right, and they'll come to those companies who make them feel safe, but are able to build a relationship with them. So social media is here to stay, guys, and boy, is it going to grow.
And Robert, I'll just bring you in. Would you echo some of the points you've heard there, particularly from Stuart? What's your view in terms of the future of this market and technology?
I do. I echo a lot of the points that they've raised. The market does need to grow. It does need to get more from technology to actually progress applications and stuff quicker. I think from a point of view of an advisor, we need to speed the whole process up, but we cannot let that detract away from that personal touch that we have with clients. From a lender's point of view, when it comes down to innovations through COVID that we've learned, to things like signature-free applications and different things, that sort of thing is where they need to evolve as well. Having online platforms that we can actually put business on that are signature-free, that we can get an interaction between putting an application on, going straight to an e.surv valuation. That's the sort of thing that we can do to get the valuation done back and then offered as quick as possible, with a view then the solicitors need to be again using technology to interact at the end of that process to actually draw the cases to a close as quick as we can.
Thank you, Rob. And Stuart, the final word of today falls to you. What do you think are the key learnings for this industry from a technology point of view as we exit hopefully out of the other side of this pandemic?
There's an old phrase that if you don't know where you're going, how do you know when you get there? Let's put our space helmets on here for a second and go into the future. And let's just imagine a scenario where we can talk to our clients with virtual reality video conferencing. We can access through open banking their latest financial bank statements, assess electronically affordability. We can incorporate all the elements of the sales process through very much more progressed technology interaction, bringing all the components at the push of a button. We automatically generate the paperwork with electronic signatures for sorting out an LPA and the customer's buildings and contents insurance, and assess their benefits and do a composite automated produced report, summary and suitability report that echoes from all the different product areas, later life lending products, second charge borrowing, RIOs, and all the other products to factor into best advice. The highlighted points that the FCA have recently come out with, well, welcome to tomorrow, because that is here now. We just need to join the final dots up. So I think what I've learned from today and the message that I send out is all of those parts are there. Let's put them together. Let's work together to get those connected, and we can move into that world without losing our customer service and integration with the consumer's needs.
Thank you, Stuart. And thank you to all of the members of the panel here today. It's great to be joined by you today and to have your thoughts and input onto the future of technology in this industry. But now I'd like to hand it over to you and to get your questions for any member of the panel here today in terms of what you want to know about the future of technology in the equity release market. So it's over to you.
So thank you for joining our panel debate today. I hope that was informative, and once again, thank you to all of the panel members who joined us today. So now is the time to type in your questions, and I will put them to the appropriate member of the team. I think we've got one or two connection issues with one or two of our presenters, but hopefully we can resolve that over the next few minutes. If not, and they can't join us via the telephone line, then we'll put any questions to them after the event and get back to you. The first question that's come in, sorry, I can't think who it's from, but I'm going to put it to you, Stuart Powell, if I may, and that's in relation to the use of social media, and you talked very eloquently there about the rise of the use of that type of technology. But for an advisor, and this is a question that's coming from an advisor that's not used to that, perhaps they're not already using social media, it might seem like a bit of a dark art. Have you got any tips or hints on how to get started if you're not currently using that as a communication channel?
Yeah, it's a great question. One I
Please hold.
Hello, have you got me there?
Yeah, carry on, Stuart. Yeah, go.
Yeah, great. So, yeah, the key to starting off on social media, in my view, is do something. It's one of those things that unless you try something out, unless you get on it, you're never going to conquer any fear you've got or any fears you've got of the quality of what you're going to produce. I would say, first of all, join a Facebook group, whether that be there's a couple of mortgage ones out there or our Equity Release Hub group, because you're amongst friends. There's equity release advisors on there, there's lenders, and the questions you ask are always supportively answered. One of the things about social media, when you start doing your own marketing and advertising, there's a lot of trolls out there, and that can knock your confidence. So start off with something you know, and then join something like LinkedIn, form a profile, but kind of do a bit of stalking to start with, and I mean that in the best way. So read what other people in your industry are writing, comment on their posts, be nice, be supportive, don't sell, just comment, be known for someone who's commenting. Grow your group with like-minded people that you think would share your interests. And then when you start to post, you'll already have a ready-made group of people whose comments you've been or posts you've been commenting on, and therefore they'll comment on yours. And that's very much how LinkedIn works, and that's how you build a network and get your posts viewed. So yeah, a couple of tips there.
Hello, is anyone there?
Yeah, hello. Leon Cole's on the line. Yeah, Mark Goodfellow speaking as well.
Right, seems to we've got a technical issue. I don't think anyone can hear anyone.
Oh dear. I would dial off and dial back in again. Let's see how that works.
Hello.
Hello.
Hello. Sorry, that we might have had a slight technical hitch with the sound. So I understand Leon Leon Cole from joined. So thankfully, I know you're having some problems with connectivity there. So I'm going to pose the question again because I think we might have lost sound just temporarily. The second question is in respect of vulnerable clients. And Kay's question is, if we see technology as playing an ever greater part in the role of this industry, what challenges do we face on vulnerability? And I want to pose that question to Rob Brennan and also Stuart Wilson from Air in a moment, if I may. This is a really important subject, isn't it, everyone, in terms of the regulator, our industry, vulnerable clients is an important topic. So, Rob, what's your take on this? Does technology help or hinder in regards to vulnerable clients?
I think it's an interesting question. I think from a vulnerability point of view, clients have to come first. And I think as an industry, we have to understand that, for certain clients, technology is a hindrance to assessing the vulnerability of certain clients. And it needs to be used in the right way. For clients who are vulnerable, then we perhaps need to go back to that face-to-face, hand-holding, really nurturing clients who can be perceived to be vulnerable. We've had issues lately where we've had clients that are deaf or hard of hearing, a bit of coercion and different things. And that's where sometimes you can't spot that from a technology point of view. I do think from a vulnerability point of view, a face-to-face approach is certainly a much better way because you can actually sit with the clients, you can understand, you can spot more vulnerabilities. For a vanilla client where, they just want, some advice, understand what they're doing, there's no vulnerability issues, then technology can be fantastic and we could speed up the whole process. But I certainly do have concerns and reservations, of doing certain types of business with certain types of clients. And I do think that we can't lose sight of the face-to-face approach in those areas.
Thanks, Rob. And Stuart Wilson, if I can bring you in on that point, would you echo what Rob said there? Is the rise of the use of technology, is this helping us in regards to vulnerability? Is it a tool that gets in the way? What's your take on this?
I think there's two sides to that, Stuart. It's not as simplistic as it may appear at the initial question. That there's two angles. Firstly, as Rob's alluded to, and I'll just paint a sort of simplistic sort of view of this. If you're using Zoom, for example, on a video call and all you can see is that customer that you're talking to, what therefore might be exposed is in a face-to-face situation, you would see somebody else in the room that was exerting pressure. And I'm just being slightly disingenuous here, but there is a exposed vulnerability issue that you need to be aware of. When you're on camera, you can only see what you can see, so you need to be peripherally aware. The flip side of that is that video conferencing, as was alluded to in the sort of panel debate, also brings the opportunity of involving family more easily. So if the family is spread to the four corners of the planet, now suddenly technology can incorporate those family members, assuming the customer wants them involved, far more easily than trying to physically, in the old style, pre-COVID, get them all in the room at the same time. So there's a double side to that. There's also an interesting dynamic of where technology can evolve us. Now, we will be doing some webinars and things specifically on this subject, and it's quite a deep subject, so I'm not going to go into it in depth. But technology, we're doing some very interesting experimental work at the moment and exploring with specialists how algorithms and technology can help identify with systems, for example, that are built into online fact finds to flag up vulnerability
and capacity issues. So technology can play a very exciting part as we move forward in helping us as advisors deliver a far more robust proposition. But I think, as Rob and others have alluded to, it doesn't totally replace the human aspect of this job. We're not trying to create robots to take the world over. What we're trying to do is to create tools that support the advisor in doing the job of delivery that they seem and that they're happy with and their customers are happy with.
Great stuff. And Leon, I think you're on the line now. I know you're a colleague of Mark's from e.surv, Leon Coles. Welcome. I'm not sure if the Mark's on the line. I know we're having some difficulties connecting, but if we've had a question from John Cobble. Thank you, John, for your question. This is definitely one to put to you guys in e.surv. So I'll hand over to you again. I don't mind if it's either Leon or Mark that answers this question, but the question from John is this: valuations and estate agent valuations appear out of sync. Are there any plans or current dialogues to address this? Regular down valuations seen since lockdown. So this is I guess a perennial subject in our industry. This whole topic of, also on the one hand, people call them down valuations. I guess you guys would prefer that they were regarded as corrections of overestimations of values. But to John's point, are there dialogues that go on between different stakeholders in this industry that look at valuations of properties?
Yeah, hi Stuart, it's Mark here. How are you doing?
Hi Mark.
My name's Darling. Okay. So down valuations is a term that we don't generally recognise. I think what we are seeing is overestimates of the market value, which is a bit of a mismatch with regard to the customer expectations. So one of the things that we do advise is that advisors could use various reputable AVMs, so automated valuation models, and ones that come to mind are Zoopla and Rightmove, and they are good indications of house prices to get a better valuation, a market valuation of a property. But one thing is very important when using those tools is that you are looking at similar properties to the subject property, rather taking the average or the highest house price in the street. And it's all around setting those expectations, using data to inform the valuation. And then when our valuers attend the property to appraise that, then they're more likely to align together and therefore reduce that friction between what the valuer has put through and what the customer is expecting their property to be worth.
Just to come in there as well, it's Leon here. So absolutely echo those points that Mark has raised. But the aim of a surveyor is not to set the tone of the market. So we will do all we can to look at the area in question, look at the sales, and look at any sold subject to contract data that may be available. So the important piece is here we have to justify that value. And if there is no evidence, then that's where perhaps you're seeing these overestimates come back a little bit. But at the same time, we will not set the tone of the market. We'll look at the sentiment in the market, and we regularly hold calls with RICS around the industry and the sentiment in the market to try and support those values where we can. So just come in there and cover that point.
Great, thank you, Leon. Thank you, Mark, for that answer. And Rob Bowes from Iress, I'll just bring you in now to a question that's been asked, or just a follow-on really to a point that you made. I think you said earlier on when we were talking about the development of API integrations on portals, and I think the point you made very valuable was that the everything being joined up at the end isn't necessarily where you start. It's a destination that we aim for. And you talked about the next logical step beyond the current developments that have been made is that further integration where advisors can get straight through from a sourcing session into a lender's portal at just the right point to begin their application journey. Are we likely to see that kind of integration sooner rather than later, do you think?
Yes, absolutely, Stuart. So it's, I think I mentioned, it's something, it's a pattern that's long established in other lines that we've been dealing with for sort of over 30 years, really. In terms of that, basically just click a button, use all the data you have, and then just arrive at exact case. So what we're doing now is basically defining the industry standard and talking to a number of the lenders about that, especially the ones that already have the real-time quotation and care-fi capability. But yeah, absolutely, we expect to make a start on it fairly soon. So it's it could be this year, it could be into next year, just depending on how working with all the partners goes. But yeah, very real thing. We've seen it delivered before, so yeah, can't see any reason why that won't proceed. And it's just another great step, really, just in terms of making a broker's job easier, really, just not having to navigate around, find things, log into different systems, and there's also things like the seamless sign-on that we have in place for the KFI journey now, which means that once you put in the credentials once for the lender's platform, we keep those details, but basically we, via tokens, we don't know the details, and can actually take brokers straight in. So just making things as seamless as possible, and just so brokers can spend time on the things that really matter rather than just navigating systems.
Great stuff. And a question's just come in from Elaine, which I want to go back to Mark and Leon on, because it does sort of follow on from the point you just made. But Stuart Wilson from Air, just to reflect what Rob said there from an air sourcing perspective, is this the sort of thing that that you're seeing growing demand from your members, this greater interconnectivity of systems so advisors spend less time rekeying and a faster, smoother process through to application?
Yeah, absolutely. I won't sort of dwell on it too much because I think Rob's very succinctly covered most of those points. We're certainly seeing demand. It's a chicken and egg situation here that the providers are now realising that this is an essential progress they need to make. It's interesting, we built Air ready for API plugins over 3 years ago, and we're still waiting for the lenders to get to that point of being able to plug into the mechanism. So we're prepared. The system's ready and waiting. I'd anticipate that what will happen here is that as soon as the first lender goes over the line with a fully functioning API application seamless process, then all the rest of them will quickly not want to get left out, and it will adrenaline shot the race to the finish line for everybody. We are, as a sector, incredibly clunky, and it's very interesting. If you look at the API that we built with Knowledge Bank, you can go in, put one set of client data in, you can move that from the fact find into the product sourcing or into the criteria sourcing without having to rekey that information. That's what that does. We need to get to a point of efficiency that drives this forward to cut down the time that we spend.
That's loud and clear, Stuart. So lenders need to pull their socks up by the sounds of it. And Elaine, thank you for your question. It sort of follows on from, I think, the point that Mark and Leon were just making. So Mark and Leon, I'm just going to push this to you. I think, Mark, you were saying about the advisors using AVM technology to help them with their discussions on the valuation of property so they can get to a more realistic property value. Elaine's question is this: the property is quite old, and the client's been living there for many years, and Zoopla might, for example, give quite a wide range for evaluation. So how do advisors work out what a suitable value would be? I guess this is kind of playing into the point that technology can only do so much, but the property valuations can be quite difficult to get to, especially on older properties, can't they? Are there any thoughts or hints there you can give?
Yeah, so I'll come in here, Mark, if you want to come in afterwards. So I guess points around where to look for your estimates. So if you're using something like Zoopla, which is just using an algorithm and an estimate based on perhaps a previous sale or previous sales in the area, it may be more beneficial to try and look at what the valuers will actually have to look at themselves, which is sales or sold subject to contract, tied up sales. And we tend to look predominantly around Rightmove. And if the information isn't there, we will look at other sites. But I would always recommend a good starting point is have a look at Rightmove and see what's sold. And as recent as possible, because that tends to be the most relevant comparable. And again, that will also show you the property. So if you have a look at the pictures on the sales details of the property, it will give you an indication of whether you're comparing with something that's fully modernised, everything's been done to a really high standard, so likely to be at the higher end of the range, or if it needs a full overhaul. So that would be probably a good bit of advice, as opposed to just looking at that Zoopla estimate, which is a real vague way of putting an estimate through to help the valuer as well, because you'll also then experience what the valuer needs to do to be able to justify the value.
Yeah, I'm right to add a point there. So as Leon mentioned, the valuers research various data sources to get information to inform their appraisal. One of the things that we find within the equity release market when we deployed the remote valuation product was that many equity release properties tend not to have that current sales footprint. So one of the new developments that we are working with the sector on is a concept whereby consumers could potentially contribute their own information into the valuation process. So by providing photographs of their property taken in real time, then the valuer will have up-to-date information about the condition of that property, which will obviously inform his or her valuation. So again, just going back to the theme of the conference is around using data and technology to improve the customer journey. We believe this could be a good innovative way forward to allow the customer to be part of the whole mortgage application process.
That's brilliant. Thank you. I think we've reached the end of our time limit now, so there is another summer refresher course or session starting in just a few moments, and I don't want any of our attendees to miss the start of that if you're booked onto the third session. So thank you once again to all of my panel members, Mark Goodfellow, Rob Bowes, Stuart Powell, Stuart Wilson from Iress, and Rob Brennan. Really do appreciate your time. And thank you for watching. I hope you've enjoyed this slightly different approach to presentations than we normally do. I hope that's been helpful and informative. I think we had one or two gremlins on the audio at the beginning of the Q&A, but I think we got through that, and certainly lots of questions coming in. So I think that's all worked in the end. So thanks for bearing with us on that. We will be writing or emailing to you all some requests for feedback on these sessions, and particularly this panel debate, to see if this is the sort of thing that you'd like to see more of. If I can get together with more subject matter experts to answer the kind of questions that you want to hear more about. So please look out for that in your inbox in the fullness of time. But for now, I'll call this meeting to a close. Thank you for joining us today. Hope you can join us for the next session, which is a fantastic demonstration of the air sourcing tool by Helen Smith. And if you can join us for that, that starts in just a few minutes' time. But for now, thank you once again to my panel members and for you for watching today. And we'll catch you on the next session. Thank you very much.